Thanks for tuning into BQ Conversations. I'm your host, Neeraj Shah. Well, my following of Morgan Housel on Twitter and reading his columns that he writes leads me to think of Morgan as a thinker who dispenses some tremendous wisdom directly and obtusely as well, via use of words chosen wisely, via use of articles written well. And as I said, it may be in the form of a story or a tweet or a book. And there's a book of Morgan Housel called The Psychology of Money, which releases in less than a fortnight from now. We have Morgan Housel joining in today to talk about his takeaways on a lot of things in the post-COVID world and to talk about his book and what one can expect from it. Morgan, great having you. Thanks so much for joining and hope all is safe.
Thank you so much for having me. I appreciate it.
Yeah. So Morgan, Jason Zweig in his review has said that this 242-page, easy-to-read book by Morgan Housel isn't about investing. It's about how to think about investing, and it's one of the best and the most original finance book in years. Tell us a bit about this book, because I'm sure not just me, but a lot of people who are watching this as well are very, very curious and excited to know what they can expect when they open the book.
Well, look, in about 15 years of writing about investing, I've always covered kind of the history of investing and investing psychology, the history of how people think about money, what we can learn from that, and how we can become better investors ourselves. And what really became apparent to me over these last 15 years is that investing is not the study of finance. Investing is a study of how people behave with money. Because the most important facts of investing, the most important aspects of investing are topics like your relationship with greed and fear, your ability to take a long-term mindset, who you trust and who you seek information from. And those things are not quantitative topics. Those are all behavioral topics, these soft psychological topics. And they tend to get swept under the rug in investing because people want to think of investing as a math-based field, that it's something like physics, where there's data and formulas that tell us exactly what to do with a lot of precision. And it's just my belief that that's not the case, that investing is a really soft, basic field. And one of the ways to sum this up is to think that, there are people in investing who have no education, no investing training, no financial background, and can, and sometimes often do, vastly outperform people who have the best education, the best background, the best financial training. There are people who have just dollar cost average into low cost funds over the last 30 years. And those people have massively outperformed some of the most educated and sophisticated fund managers in the world. And there's no other field where that's really the case. And I think the reason it's the case is because what really matters in investing is not how smart you are or how sophisticated the spreadsheets and the models that you are using are. It's how well you behave. It's whether you can keep your head on straight during booms and busts, and whether you can actually take a long-term mindset, whether you are gullible or not to kind of switch in and out of different products and think that you can predict the future. It's all these soft topics. So the book is structured as 19 stories. Many of the stories have nothing to do with investing whatsoever, but they teach us about how people think about risk and greed and fear and opportunity and scarcity, which is kind of the backbone of what investing is. So there are all these stories that have nothing to do with investing that come around to a clean investing takeaway about how we can think about our money in a more productive way.
You are effectively saying, Morgan, that to an average investor, that even if she doesn't have formal education about balance sheets and spreadsheets, so on and so forth, does have a chance to be very successful in investing by use of a lot of behavioral techniques and in a manner of speaking, kind of mastering them, right?
That's absolutely right. Look, if you live below your means, so you're saving money, and you dollar cost average into a low cost index fund, and you leave them alone for years or decades, if that's all you do, you will outperform the vast majority of professional investors over time. It's been true in the past. It's been true over short periods of times, long periods of times. We know that's the case. And those skills that I just laid out, living below your means, dollar cost averaging, being patient for years or decades, that has nothing to do with getting your MBA at a top flight school or interning at Goldman Sachs. You don't need any financial sophistication to get that done. You just need to be a little bit patient and have the behavioral mindset that is needed to do well at investing. On the flip side of that, you can be the most sophisticated investor in the world, one of the best stock pickers. You can have an incredibly complex model that's going to tell us where the economy is going to go next. But if you panic in March of 2020 or in September of 2008, none of that matters. All of that's going to be wiped out by the panic that you put forth during your investing times.
Yeah. Yeah, well, this is music to the ears for almost every every lady or gentleman who's seeing this right now. Morgan, a couple of things that I picked up from the from the review that has been written, the one review that I read, which is written about the book, and it's an interesting one. But I think you are saying in the book that people, you use the example of a person who deferred gratification, had no need to spend big in order to show people that he was not so. And the line is very profound and powerful for me, that old-fashioned virtues, great fortunes can be built. The only thing that I hear from a lot of other people as well is that if you keep on thinking about saving for the future all the time, you kind of miss out on living on the present. How do you kind of, split or think about the two?
Well, look, whenever someone like myself says people should live below their means and save money, that's not a plea for people to become monks and spend absolutely nothing. I like nice homes and nice cars and nice clothes as much as anyone else, but it's just a matter of what your means are. And as long as you have a gap between your income and your needs, then you're going to do okay overnight. Then you're going to do okay over time. One point that I make in the book that I think is really important is that wealth is what you don't see. Wealth is the cars that you didn't buy. It's the clothes that you didn't buy. It's the house that you didn't buy. Wealth is assets that you have saved up and have not spent. And everything that we see, whether it's other people's cars, other people's homes, that's money that's been spent. That's not actually wealth. Wealth is savings in the bank that you have not spent yet. And so wealth is this invisible concept, which makes it really hard to learn about. It's hard to learn from other people about it because we don't see it. We see people's cars. We don't see their bank accounts. We don't see their brokerage accounts. And then people will ask, well, what is the point of having savings that you're not going to spend if you're not going to go out and use it to enjoy your life? And to me, one of the points that I make in the book is what tends to make people happy over time, and it is enduring happiness, you're not going to get used to it, is control over your time. The ability to wake up every day and say, I can do whatever I want today. I can work where I want. I can live where I want. I can retire when I want to do. Having control over your schedule so that you own your time rather than someone else telling you what to do, that is going to create a level of happiness that is not only a high level of happiness, but an enduring level of happiness over time.
Most certainly. Most certainly. Okay, interesting point. Morgan, one more question on the book. I don't want to make this only about the book because I want people to go out and try and read it, because I think viewers, I think when you read a book in its entirety, it can give you lessons and fascination and happiness that could probably not come from watching an interview. But still, one last thing, Morgan, that I want to get your view on. I was a bit confused about your assessment, and correct me if I'm wrong here. You mentioned, I think that investors think of volatile times as a kind of a fine for having made a mistake. And instead, they should regard it as a fee, which is the unavoidable cost of participation, because you do not know how big the fee will be or when will you incur it. My question is, how does an average investor decide whether this is a permanent fine or a temporary fee that is coming in? That would essentially require a very in-depth knowledge about what the business, etc., is going through, etc. Right? There can't be a generalized statement like this for when these fees or fines occur.
Well, I think what's really important for all investors, whether you are amateur or professional, is understanding the history of volatility. And a lot of professional investors, even the most sophisticated investors I found, don't quite understand it, don't quite have a grasp on how common and how normal even extreme volatility is historically. So if you look in the United States, the stock market has on average declined at least 10% at least once a year. It's lost 30% of its value at least once or twice per decade. And so that kind of stuff is the normal path of success. So our stock market has done very, very well over the last 100 years. But if you think it has lost 30% of its value at least once a decade, that's the normal path during a successful investing path. And so if you realize how normal volatility is, then when it occurs, it doesn't feel like something is broken. It's not to say that it doesn't feel good. In March of this year, when the market fell 30%, that's not fun for someone like myself to go through. It's not fun for anyone to deal with. But if you realize that it's normal, it doesn't mean that the market is broken. It doesn't mean that something is wrong. It doesn't necessarily mean that you need to take an action to fix it. It's the normal path of what's going on over time. Just like if you live somewhere and there's a heavy rainstorm, it's not necessarily fun, but it's normal. You know that because it's raining doesn't mean that you need to move out of your, you need to move out of your city. It's a normal thing that occurs over time. So I think just understanding the history of volatility goes a long way to getting people to think about volatility as a fee that you have to pay, the cost of admission to long-term success, versus a fine that you did something wrong and you need to avoid it in the future.
Well, interesting. And maybe laid out on the current parlance as well. Well, Morgan, speaking of that, and of course, I wish you all the success with the book, Morgan. It's already a much sought after book, and I'm hoping that it gets even more success. But and all the best for that. Can I just take a bit of a deviation from what we're talking about and move on to how you think about the current situation as well? Because it almost seems as if good news continues to eclipse the bad news, because investors who are awash with cash, and that's an assessment that I read somewhere, that investors awash with the stimulus-infused cash are keen to get their hands on anything that will yield higher return than government bonds. Is that how you assess the current market situation and the rallies?
I think that's certainly a part of it. There's always many, many factors that are going into what's pushing the stock market, what's pushing the economy, and that is one of them. Just the fact that interest rates are so low and there's so much stimulus from central banks around the world trying to prop up the economies, that some of that liquidity that they're injecting into the economy is going to find its way into the stock market. That's definitely one element to it. But there are a few other elements that kind of explain why markets around the world have done so well despite being in the worst economic crisis since the Great Depression. One of them is stock markets. If you look at the United States, but this is true in almost every region, stock markets are heavily concentrated in some of the biggest company names. It's not that, even if you look at the S&P 500, 25% of the index is 5 companies. It's Google, Amazon, Facebook, Microsoft, Apple, just that. And those companies are doing very well during lockdowns. They're doing very well in 2020. A lot of the businesses like Amazon are surging because of COVID-19. And when those companies make up a disproportionate share of what we call the stock market, then of course the market is going to do well, even if the vast majority of small businesses, medium-sized businesses, non-public companies are really struggling like they never have before. So that disconnect between the stock market and what's going on throughout the rest of the economy is wider than it's ever been. The other thing that's going on right now is we have, in the United States, the highest unemployment that we've had in generations. But we have so much government stimulus, and this is true in many parts of the world, in the UK, in Australia, throughout Europe. We have so much stimulus offsetting that even though 40 million Americans lost their jobs, we had the extended unemployment benefits that gave these people who lost their jobs more money than they'd ever had in their lives. So even though we had record high employment, we had record high income at the same time and record high spending. Our consumer spending is back to an all-time high now, even though we have the highest unemployment that we've seen in decades. So you have these disconnects that are hard to make sense of. And that might be why we can have, at the same time, the worst economic crisis we've seen since the Great Depression and a record high stock market at the same time.
Does it bother you, Morgan, this dichotomy or the disconnect between economy versus what the market is telling you or trying to tell you?
I think one thing that's really true is that one of the biggest stories in economics, and this is true across the globe over the last generation or two, is rising wealth inequality and income inequality. There's this growing gap between those who have a lot of money and those who are struggling to get by on a daily basis. And COVID-19 just exacerbates that, because now you have a group of people, one set of people who can do their jobs from their home, like you and I, and another set of people who can't work at all. They haven't worked since March. And they're just losing their skills, losing their connections to the workplace. And then you have people who own stocks who are back at an all-time high. Their wealth is at an all-time high versus people who don't. And then, they're struggling to get by. So the gap between the haves and the have-nots was already growing for the last 30 or 40 years. And just in the last 3 or 4 months, it's blown apart even wider. So I think that's already was one of the biggest stories, and it's only going to grow in the coming years and months.
I described you as a thinker, Morgan. Just an offshoot question away from markets and economy, but in real life, such transgressions don't necessarily end well, right? Because it's not normal and it's not good, as you say, right? For lack of a better word, for this to happen. What do you think happens next?
It's so hard to say. I mean, the biggest takeaway from 2020 so far is that the world is surprising. The biggest takeaway is that there are things that happen that no one could have seen coming, whether it was the pandemic itself or the rebound in the stock market and the economy that's taken place. It's so hard to see what's going to happen next. But here are a few broad thoughts that I have about this. If you go back to the 1918 flu pandemic, there aren't a lot of indications that when that was over, if you go into 1919, 1920 and beyond, that there was a lot of permanent consumer changes that took place. The 1920s in the United States, after the pandemic, that was the era of the jazz bar and the speakeasy and dance clubs, nightclubs. So when the flu pandemic was over, that was so far much worse than what we've dealt with COVID-19. People went right back to their lives. They went right back to the restaurants, right back to the bars. So something like that makes me think that that once this is over, whenever that is, however you want to define over, whenever that is, maybe it's when we have a vaccine, the people by and large will go back out to the restaurants. They'll get back on the airplanes. They'll go back to conferences like they were. And there might even be a lot of pent up demand for that, for people who are dying to get back out on an airplane, dying to go travel. They can't wait to do it. So I tend to think that many of those changes will just be temporary, that we'll go back to our old way of life. But there still are going to be scars of what we've dealt with. In the United States, I think two of the scars that we will deal with that will be somewhat permanent changes. One is a higher propensity to save money and a lower desire to have debt, just because people were so shocked at the economic carnage that took place in March and April this year, particularly if you are a business owner, many of whom went from record sales in February to bankrupt in March. It just happened so quickly. That is the kind of thing that will, for the rest of your life, make you want to save more money and have less debt. That was the same thing that took place after the Great Depression in the United States, where that created a whole generation of people who wanted to save more money and take on less debt. The other thing that I think we'll see in the United States that has been kind of a political tension point since the end of World War II is a higher demand for social safety nets, whether that is enhanced unemployment benefits, maybe it's healthcare for all, that kind of thing, which has obviously been a battle in the United States for a long time. But once you see something like 40 million people losing their job in a 6-week period, that's when you're going to have kind of that shocking event that pushes people to say, okay, having a higher safety net is something that I want in life. So I think whether it's from Republicans or Democrats, it's something that we'll see going forward.
Just a follow-up there, Morgan, about economies or countries which don't have the balance sheets to be able to give these social security nets. They've not done that. I mean, India as an example, right? We haven't been able to give the kind of stimulus that some of the other developed nations have. And job losses are probably there across all the nations. What happens, because we've already seen the last 3 years or 4 years or 5 years since Brexit, this whole globalization theme not come to an end literally, but something like that. And a lot of nationalism, etc. And now with this whole anti-China wave, there is probably even more. I mean, in India, we've seen cries and cries of "Make in India," right? So, what happens to both of these things? One, the countries which are not been able to do well, and therefore the rising cry of nationalism. And two, the fact that everybody's kind of saying that, hey, let's move away from the shop floor of the world because they've kind of exported, quote unquote, the virus to the world.
Yeah, so I mean, in terms of where different economies are going to go because of their political movements, that who knows? I don't think anyone knows, but that's definitely not my sphere. But here's one thing I would say, for the countries that cannot backstop their economies with a big balance sheet like we're doing in the United States and throughout Europe, it's going to be significantly tougher. There's no way around that. That you can deal with something like we've been through, and if you don't have that backstop, it's going to be tough. It's going to be very, very tough. There's no way around that. But here's a bit of optimism that I would leave you with. At the end of World War II in 1945, Germany's economy was completely 100% obliterated, bombed into rubble. There was almost nothing left. It only took 3.5 years for Germany's GDP to exceed its pre-war all-time high. So from rubble, from a completely destroyed economy, it took 3 years to regain everything that they had lost. So there's a long history of economies being really bludgeoned, hit really hard, and coming back not only quickly, but completely regaining all of their loss in a fairly short period of time. Now, 3 years is a long period of time if you are one of the people who lost their jobs, lost their businesses. I don't want to downplay that, but there is a long history of things coming back faster and more powerful than people had imagined in the depths of the crisis.
Yeah, well, that's true. One final question, Morgan, because I do want to talk about some of the other behavioral pieces more than the current market conversation. But just one thing which is kind of, I thought I'll ask you. So Bloomberg did a story recently about surveying, I mean, they surveyed multiple managers, money managers, and how while the majority of people, at least the ones surveyed, thought that Joe Biden will win, their beliefs of the impact of that victory that could come on the markets and economy was split right down the middle. My question to you is, for a binary event like this, and which is arguably one of the most important ones in recent times, how does Morgan Housel, the investor, prepare for?
Well, I won't make any changes to my investing, regardless of who wins the election. There's a very long history in the United States of investors saying, if this person wins, here's what the market's going to do, and if that person wins, here's what the market's going to do. They are some of the worst forecasts that you can imagine. They have some of the worst track record that you could possibly imagine. I mean, just going back to the last few presidents, when George W. Bush won in 2000, a lot of people said, oh, he's going to cut taxes and there's going to be a lot of deregulations. Buy the airline stocks and buy the banks, because those are the sectors that are going to really win. Within 3 years, all the airlines were bankrupt, and then the 2008 financial crisis wiped out all the banks. So, you know, the easy soundbite that made sense didn't work. When Barack Obama won, a lot of people said high taxes, the stock market's going to plunge. The stock market went on to, I think, you know, to more than double during his term. When Donald Trump won, the immediate sense was this is going to be terrible for the stock market. You know, sell your stocks. On the night that he won the election, stock futures plunged in anticipation of what might happen next. And of course, the market has surged since then. So there's a very long history of the narratives of what's going to happen based off of the election being actually the opposite of what people think is going to is of what actually happens over time.
Okay, maybe the same thing to do. Morgan, I'm shifting bases now. We have about another 10, 12 minutes left. I want to talk about 3 or 4 pieces that I've read of yours, which are, to my mind, the most important ones for me. I have a bit of a recency bias, so excuse me for that. But I want to start off with something that I messaged you about as well, which was really profound a read for me, which is the 3 sides of risk that you wrote. Yep. It was fascinating. It was touching in a big way. But it also gave a lot of lessons. Now, my question to you is, you already wrote about what you thought of that event in that article, and that's for everybody to see. I urge everybody who is not ready to please go and read it. But since then, you would have had multiple conversations with people who would have asked you a few things. You would have told them a few things. Are there any reflections on either that article or subsequent conversations that you had with people who read it, and some other lessons that came out of it?
Well, one of the things I wrote in the article is dealing with something like that, in which it's an article about the death of 2 close friends that I had. And one of the things I wrote in the article was, look, I know this story is not unique to me. Almost everyone has lost someone dear to them. A lot of people have had near-death experiences themselves. So when I wrote it, a lot of people wrote back and said, I have a very similar story. Here's my story. So these kind of things are, you know, is just kind of a part of life. It's a scary part of life. It's not something that we want to think about, but risk is an ever-present part of everyone's lives that we have to deal with. You know, dealing with, you know, if you separate risk into those 3 sides of risk that I talk about, which is the odds of getting hit by a risk, the average consequences of getting hit by a risk, and then the tail consequences, the really far and extreme consequences of a risk. I just think that's a really important way to think about risk. And that's true not just in life, whether it is skiing or driving a car or it is investing. I think that is always how risk works. And when you think about that, the most important part of that equation, the most important of those 3 sides, is the tail end events of risk. That is what actually moves the needle in life. That's what moves the needle in the economy. That's what moves the needle in the stock market. It's not the average things that occur on a daily basis. It's the things that happen once every 10 years, once every 20 years, whether it is COVID-19 or the 2008 financial crisis, September 11th in the United States. You know, there's usually an event about once every 10 years that makes up the majority of what matters over that 10-year period. And if you think about it in those terms, and what happens on a daily basis, the things that we think about in the news headlines all day, don't really matter that much for us as investors. It's going to be the 1 or 2 events over the course of the next 10 or 20 years that really moves the needle over time.
Yeah, but Morgan, just to follow up, if we classify events into 4 quadrants, which is the known knowns, the known unknowns, the unknown knowns, and the unknown unknowns, most of these, the ones which have a fat tail, risks, would be the unknown knowns. How does one, I mean, you know, prepare for such a thing which is an unknown known, because the timing and the magnitude is almost unknown, right? It's impossible to gauge.
It's impossible to gauge, right? So how do you prepare for things that you cannot even think about? I don't think there's a perfect answer for that question, almost by definition, but there's two things I think people should keep in mind. One is that people should think more about expectations and less about forecasts. The difference is this. If I say there is going to be a recession in 2022, that's a forecast. But if I say you should expect there to be about 1 or 2 recessions per decade, that's an expectation. I'm not telling you when it's going to happen. I don't know what's going to cause it. I don't know where it's going to happen. But if you are expecting them as just your baseline set of expectations, then when it happens, you're not necessarily surprised about it. It doesn't feel scary. It doesn't take you aback. It's not shocking because you were always expecting it to happen at any time. So expectations rather than precise forecasts is one of the ways that you can, sort of prepare for things that you're not actually thinking about. And this is how people like in California deal with earthquakes. No one knows when the next earthquake is going to happen. No one knows where it's going to occur. No one knows what's going to trigger it, but they're always expecting there to be earthquakes. At any given time, they know it's a possibility. So they're prepared for it. I think that's how people should think about investing risk as well. The other thing that's important is just saving for saving's sake. There's so many people who think that you need to save, because you're saving up for a new car or a down payment on a house, or you're saving for retirement. And I think just saving without any specific goal is the right thing to do. Just having room for error in your finances that is prepared to deal with the unknowns that you're not thinking about. And a lot of people during boom times especially will look at their finances and say, why do I have so much cash? Why do I have these bonds? Because they don't see the risks that are out there in the economy because the risks are unknown. So I think if you have room for error in your portfolio that can absorb unknowns, even the things that you're not even thinking about, that's actually the best form of savings that you can have rather than saving for a specific goal, a specific event.
That's interesting learning. Thanks, Morgan, for that. The other one is something that you wrote maybe 3 days back, 3 days before that article that came out, which is what always changes. And in that article, you wrote about 3 points. I've picked up the first point, which I thought was really, really important, which is the information and the metrics that people pay attention to keep on changing. And therefore, even if you know what's going to happen, you don't quite know whether other people will care. Now, when you look at the current investment climate, and I know you probably give an example of Uber, but I'm just trying to think in a post-COVID world, how do you apply this particular teaching or learning of yours?
Certainly, if you look at the last 10 or 15 years, value investing has done very poorly. People who are paying attention to PE ratios and free cash flow levels, that investing strategy has performed very, very poorly. And what has done very well are people who have just paid attention to revenue growth, which is why companies like Uber and those kind of companies that have no profits or not even close to profitability, and they have a lot of top line revenue growth, those companies have done very well from an investing standpoint. So, and look, we're probably going to reach another era where that flips. That was true in the early 2000s, where value investing worked very well, and high growth, high revenue, for companies that were not profitable, that did not perform very well. So it's always going to flip back and forth. We don't know when, we don't know what the trigger is going to be, but I think just always having humility that investors favor different things, different metrics, different bits of information is really important, because it makes you realize that you can never just say, this strategy works, all the time. You always have to have kind of a level of diversification and intellectual humility in your investing approach. To me, the biggest is just diversification. So rather than just being a value investor, just being a growth investor, that's almost certainly going to put you into situations over the course of your investing time where you're going to have 10-year periods of underperformance. And a lot of people, if you are a professional investor, just can't handle that from a business point of view. Your customers, your clients, your investors will flee. And a lot of people, just from a psychological point of view, if you're an individual investor, don't have the endurance to stick with something for 10 years that hasn't been working. So from that perspective, I think just a diversification of strategies within your own portfolio is really vital and important.
Morgan, my final question, and I would love to go on and on, of course, but we have a time limit too. My final question is about this piece that you've written, which is The Ugly Scramble, wherein you've drawn parallels to study done on cats from high rises, and it was fascinating. Frankly, in India, WhatsApp is very prevalent, and I send that piece on WhatsApp to so many people who are not even investors, and all of them wrote back to me saying, this is quite a fascinating point of view. My question is this: when you're saying that risk isn't always intuitive, and how risk is how hasty your response should be, You've given examples of companies and how Southwest versus United did. I'm thinking from a perspective of investors, and how should investors measure or gauge their response? Because again, I presume that the how hasty or not hasty an individual investor's response is would probably differ in every market cycle.
Yeah, that's right. And to me, the biggest thing that's important for individual investors on this topic is, again, just room for error and having enough buffer in your personal finances that has been created by your savings rate within cash and bonds, so that you can absorb things and that you can make calm decisions about the future that you're going to do with your investments, or the future that you're going to do with your career. People who have to make really hasty decisions with their personal finances are people that have lots of debt and very little cash. That is when you even have the slightest setback in your life, whether it's a recession or a job loss, and you instantly need to go out and make changes to your personal finances. You need to cut this, sell this, stop doing that. That's a really hard way to manage your personal life. It's a hard way to manage your financial psychology. So I think if people have more room for error over time, then that is what's going to give them the endurance to put up with unknowns, to deal with unknowns in a calm, coherent way. And if by doing that, they are able to leave alone, the stocks, the equities that they have in their portfolio, if they can leave them alone during the downtimes, during the recessions, during the job losses, that is when compounding is going to do the best over time. The best quote that I love from Charlie Munger about this, we can use to wrap this up, is that what Charlie Munger says is the first rule of compounding is to never interrupt it unnecessarily.
Okay, and the first rule of a good interview is not to extend it for more than it's necessary. Morgan, this was lovely talking to you today. Thank you so much, and I once again, from all of us, wish you all the very best for your book.
Thank you very much. I appreciate it.
Pleasure is ours. Thank you so much.